Good morning, everybody, and thank you for your patience there. A few technical glitches from our side. I'm very happy to have with me this morning William Fraser and Nick Balkan from Ford. They're going to give you an update on what's been happening with the fund over the recent past and some of the key concepts and portfolios positions that you will have within the fund and some projections for what will be happening over the next 3 years. There will be time for questions at the end, and I strongly urge you to take this opportunity to engage with the chaps. So without further ado, William, over to you.
Thanks, Rob. Yeah, we wish we knew what was going to happen over the next 3 years. We don't, but we think that the structure of the fund is of such a nature, and the balance in the portfolio will allow for a reasonable, predictable outcome. And I think a lot of the discussion will just go around how we have structured the portfolio going forward. But clearly the past is important, and particularly looking at the more recent returns. So the first slide, on slide 2, for those of you that has the slides in front of you, we just show the long-term track record of the fund relative to the benchmark. And since inception, we pretty much bang on that inflation plus 4% objective, but it hasn't always been a smooth path. This is a fund that has some allocation to risk assets. There's an allocation to equities, to foreign assets, property at different points in time. So one should expect that you're going to experience some volatility, which has been the case within the stable fund over the last 10 plus years. And if one goes to the rolling 3-year returns, I think it's quite obvious that there's times where markets are cheap enough to allow you to take on enough risk in the portfolio, and it allows you for gains in excess of the inflation objective, as has been the case since 2010 onwards, if one look at the rolling 3-year returns. It's been a fantastic period for investors, and effectively we gained a lot of the returns that we potentially can still earn in the future during that time where, because of quantitative easing and good earnings growth in companies, investors experience pretty decent returns.
And more, just make sure that everyone's on your slide, because I don't know if everyone's shifted to the next.
Yeah, so this is slide 3. Just shows the rolling 3-year returns, and it's probably what is causing a lot of angst within the investor base and the client base. When we look at what has been delivered relative to that inflation plus 4% objective, we're after a long period of gains well in excess of that objective. More recently, the returns have dipped below inflation plus 4, which doesn't really surprise us. I think we've made the point repeatedly during the last 2 or 3 years that given the excess returns that has been achieved in the past, it's slightly lower returns should be expected. It just happened to coincide as well with a period of increased volatility leading up to the firing of Nene and the rand depreciating significantly towards the end of 2015. So a lot of the excess returns that has been achieved up to the end of 2015 effectively has been reversed slightly in the last 3 years. Importantly, one of our secondary objectives within this portfolio is not to lose capital for investors when investment risk, in our opinion, is elevated. And for the last 2.5 years in particular has been a period where we've seen a lot of risk coming to the fore, and we have shifted towards a much more conservatively positioned portfolio structure within the stable fund. Not only through asset allocation, but also the kind of investments we own in the ESA component of the portfolio in particular. It's not a fund that is exclusively invested in money market type assets, so one should expect some volatility, but you need that volatility to achieve returns in excess of inflation plus 4% over slightly longer duration periods.
I think that's an important point, just to kind of reiterate. In order to achieve CPI plus 4, the mathematics is that you could lock in slightly less than that, CPI plus 2 if you put it in bonds or there and thereabouts, which we'll talk about a bit later. But in order to get to that CPI plus 4, there needs to be an equity component. And with an equity component comes volatility. So this is definitely not a money market fund. This is a stable fund where we attempt to achieve CPI plus 4 and to not lose permanent capital of our investors.
So just to go a little bit deeper into what has happened since 2015, and I know we're looking at the past here, but I think the context is important here. So on slide 4, we've just broken down the structure of the portfolio at December 2015, so showing how much we had in equities, property, bonds, cash, foreign assets, and then what the fund has returned from those different components. And I think it's pretty clear that if one looks at both domestic equities delivered 8%, the bonds plus cash, a combination, so that's 52% of the portfolio delivered 10%.
Just explain probably each column for everyone, because probably... So we're looking at the fund return, which is the last column on the chart, which is the actual funds return. And
we compare that against the different asset class benchmarks that we use within the stable fund. Foreign, for example, is a combination of equities, which is 60%, and bonds, which is 40%. And where we show the brackets as a percentage of portfolio, that's the current allocation to the different asset classes. And where we show the brackets for foreign asset returns, those are the rand returns. The point we really want to make here is that if one looks at those different asset class returns, it has really been driven by the strength of the rand over this forecast period, or period looking back in time. So over this time, clearly, given where we started at the end of 2015, up to now, there's been some marked rand appreciation. And while the foreign asset has delivered extremely good returns in dollar terms, the rand gain has eroded quite a bit of those dollar returns. So there's been no real contribution in rand terms from the foreign component of the portfolio, which hasn't mean that those returns have disappeared, right? It's just a case of, given what the rand has done, that there's a component that hasn't yet translated into capital gains for investors. And we'll talk about the rand a little bit later, and we still believe that there will be good gains for international assets when translated back into rands.
The other two things that I'd just like to highlight is that first column, when it says percentage of portfolio, we'll talk about why and what we did, but you can see quite a big shift from 3 years ago to today, which is in the bracket in the SA government bonds. We moved from 7% in SA government bonds to 30% in government bonds. And that, everyone asks us, how did we balance the portfolio? In our minds, what we did was we were cautious, and we'll take you through the thinking. We were cautious going to the ANC election, but to balance the portfolio, we rather selected a bigger allocation in domestic bonds and a lower weighting in domestic equities. So that came with the commensurate acceptable return and good return from the bonds, but then we didn't get the huge gearing on the positive side from the domestic equities. Just going into foreign, I think it's quite interesting. The foreign funds have done quite well, or acceptably, through what is quite a tough 3-year period for global funds. And just to highlight a few interesting things on the foreign funds, we have 3 key themes that we're focusing both our foreign funds on, our Forward International and our Forward Global Fund, which the stable fund is invested in. The 3 key themes are the aging population, where we think that through time, as the aging population in the US and other countries move into the fore, we think that that's going to be the biggest demand sector in the world, and we want to be positioned to benefit from them. big wealthy cohort that's going to spend much more as they age on well-being, lifestyle, health, and other. In doing that, we're positioned in both pharmaceutical companies like Roche, and we've seen Shire in the news more recently, where we have a holding with Japan's Takeda taking them out. And we also have a big holding in CVS, which is effectively the clicks. If anyone's been to the US, it's the clicks of the US. So that's one sector that we believe hasn't fired yet, but we think that that's a very important bucket for the funds to be positioned in. And the good news is, in recession or in good times, those sectors should be resilient. So we think that that's a very good place to be, given the world we see going ahead. The other two important positions in the foreign funds are the experiences over goods. And I think here we're positioned in things that people want to spend money on, experiences versus hard goods. And there we have things like the cruise liners, which has reduced more recently on valuation issues. But a company like Vivendi is quite an important company from an experience point of view. Vivendi, everyone knows the name, but not everyone knows what the big bucket of Vivendi is. It's music streaming. Everyone's got Spotify these days, and music streaming is where everyone's allocating their marginal money. So it's experiences over goods, and that's the kind of positioning where we are, and we think that's very exciting segment of the market. And then the last segment of the longer-term themes is the rise of the Chinese consumer. I'm not going to harp on it, the JDs, and everyone knows the story on the China internet. But the other sector that we're very interested is in China financial services. As the Chinese transition from fixed capital formation to services, they want their consumers to have safety nets so they can spend additional money. That comes with life products and short-term insurers. And we have quite big weights in a company called AIA, which everyone knows with their alliance with Discovery, and then PRCC, which we would class as the Santam of China. All these companies, a company like CVS is trading on a 9 times PE forward. PRCC is close on a 9 times forward. We think both will give high single-digit hard currency earnings growth, and both have very good dividend yields. So that's a very important way that we are going to achieve the CPI plus 4 benchmark. But as we'll talk a bit later, that doesn't come in a consistent kind of result. There are times where the PEs move around and the rand and the currencies play a role, but through time, that's how you achieve the CPI plus 4, is buying good quality companies and holding them for a long time.
Yeah, I think one example of that is look at the last 12 months and year to date, like British American Tobacco, which we think is a company with quite predictable earnings growth and a very high dividend in sterling. Despite it being cheap, there's no real short-term catalyst for the share price for that stock. So despite it being cheap, it just got cheaper in the last 12 months. It's a stock we think fits perfectly with the objective of a fund like the stable fund, but it has been a detractor of the equity component returns of the last 12 months in particular. But then just looking a bit more shorter term, that allocation towards bonds that we keep on mentioning, that in the last 12 months has contributed to about 3% of the total return over the last 12 months, of 6%. So almost half the returns came from the bond component, and year to date, more recently, it contributed for an even greater allocation of the overall total portfolio. So
that's the balance that we're kind of talking about. While the rand has obviously been a huge detractor,
correct,
it was an acceptable result given how big a weight we had offshore and the movement of the rand.
Yeah, and just to mention, and again, in the last 12 months, the dollar depreciated by about 7% against the rand, but the global equity fund in dollar terms delivered about 11.5%, and the international fund about 7%. So again, very good absolute returns in dollars, but just almost hidden by the fact that the dollar has been quite weak against the currency
But it's an important thing that we're not hiding behind a dollar return and saying to everyone, guys, this is a dollar return, ignore the rand return. What we are saying is it's context, and I think context is important in investments. Through time, currencies move, they go up, they go down. We got lots of benefit from the rand weakening 4 or 5 years ago as a bit of give back. But through time, if you do the right things, the fundamentals come through and you get paid back in time.
Okay, so let's look a bit forward and look at the structure of the portfolio and how we think we're going to deliver that inflation plus 4% objective over time. And on slide 5, we just put forward some of the real yields, and these are more shorter-term focus, so over the next 1 year, just a real yields on different asset classes. And like Nick has mentioned previously, you can invest in an asset class that will almost guarantee you something like inflation plus 2% over the slightly longer-term investment cycle by allocating all your cash in inflation-linked bonds with a relatively short investment horizon.
But you have to lock it in for 5 years to achieve the 2%.
And even that won't be a smooth return as the yield moves around, as investors' inflation expectation changes over that investment horizon. But in the absence of allocating a portion of the portfolio to equities and foreign assets, there's nothing that's going to deliver a return in excess of the inflation plus 4% objective. So Nick has spoken about the requirement to have some allocation in risk assets in the portfolio, and one can see that the only way you're going to achieve that in the next 3 years in particular is by allocating still a portion of the portfolio to equities, and we prefer foreign equities to local equities, given the prospects that Nick has spoken about in some of the sectors globally.
Sorry, I think it's important to mention that those yields, real yields for the equity classes, the total returns, right?
So those are, they forward earnings yields, but
just talk about the maths. It's quite complex per one, but actually calculatable numbers for each one. It's just simply, for the 10-year bond, would say that you get 8.5 right now, and you deduct a rough expectation for inflation, and that would give you an implied expectation for a real yield. So it's 8.5 minus, in this case, 5, which would give you the 3.5 real yield that you get. But that doesn't guarantee you a 3.5% real yield in bonds. Imagine inflation goes out to 8%, then your real yield is only 0.5. So you can't even guarantee yourself a real yield if you buy a fixed coupon bond. The only way that you can is to buy the inflation linker, because then it's linked to inflation. So what we're trying to do is highlight rough expectations where we are in each asset class, what real yield you will get, a yield over and above inflation in each of the asset classes.
And
that's CPI plus 4. You can contrast all these numbers to that benchmark of CPI plus 4. These numbers are ways to achieve the CPI plus 4.
Yeah. And on the foreign side, we haven't taken currency into account there. No. Those are dollar yields.
I would less harp on the number and not hang on, this is what you're going to achieve, rather than the idea behind it, if you get what I'm saying.
You need equity, effectively.
Yeah.
But now if we go to slide 6, then just to show you why we continue to keep the allocation in bonds in the portfolio, there's been a pretty decent rally in bond yields from just prior to Ramaphosa's election to the subsequent yield on the 186 falling from 9.2 to the current 8.4%. But why we continue to invest and keep the allocation in the 186 in particular is because of that running yield in the bonds. And that running yield doesn't change as a percentage of the capital that you use to purchase that bond. The coupon is the coupon, and because it is a fixed coupon, it doesn't change over time. So based on what we paid for those bonds, the running yield is about 9.3%. So even if inflation goes slightly higher than what we expect over the short term, the income that investors can expect from the portfolio from the bond component, we believe will deliver an income in the portfolio that will be in excess of or very close to that inflation plus 4% objective.
But that's getting a bit more technical, whereas the chart above would have been a kind of summarized thoughts on each of the different asset classes.
But it does provide a good balance in the portfolio where we don't have a huge amount of SA Inc. from an equity allocation in the portfolio. But if the sentiment for SA continues to improve and the rand continue to appreciate relative to a hard currency, inflation remains under control, and there's further reductions in interest rates locally, investors will, in all likelihood, deliver a capital gain on the bonds plus a very good income yield. So it offsets a little bit the lack in SA Inc. on the equity component of the portfolio.
And you can see pretty much on the chart on the left-hand side, you can see how we've taken the grey bars are the actual, if you follow the right-hand axis, that is our weight in the portfolio to 5-year bonds or more. And you can see it's gone from just under 10% a year ago of the fund to just under 30% of the fund. And the green line being the return you've got from the All Bond Index versus the STEFI, which is a more short-dated line. And they both indexed to 100 on the left-hand side. So what Will was trying to put together on that chart is just to show you that bonds have added value, and having a bigger allocation to bonds, unfortunately, they haven't done as well as equities. So from that point of view, they haven't contributed as much, but they have added value, absolutely.
And then we don't have more because we can't be 100% sure about what's going to happen to the currency or to inflation, right? So if we had 100% clarity on the future of the rand and we had a crystal ball and we can guarantee a certain outcome, then you may have slightly more in bonds, but we don't have that. And I think the currency is quite finely balanced today because of some local developments in wage settlements and those kind of things, but also what's happening to emerging market assets.
And the other important thing that's happened is the shorter dated bonds have stabilized more recently. Before they were pricing quite a few cuts, and the relative of extending your duration out into longer bonds was paying you. Now more recently, with a bit of rand movement and other, there's no longer the big gap between the short duration bonds and the longer duration bonds. So there's less of an urgency to extend the duration further.
And you can still buy a 12-month NCD at 7.8%, which is a pretty good real yield. If inflation below
corporate risk NCD, and it is a good diversifying contributor in a portfolio
and no upside.
Yeah.
So on slide 7, we just show then some of the opportunities on the equity side locally.
Yeah, also very high-level stuff rather than detailed numbers. But I think as we took you through before, it's trying to get to that kind of thinking on a real yield type basis. So if you think about this chart, it's not trying to say really where our total return is going. What we're saying is in the next 3 years, the second or the third column that says 3-year EG, which is earnings growth, that's effectively what we think the compound earnings growth roughly, and we use consensus there, we're not trying to get too technical, will be over the next 3 years. And obviously companies like Anheuser-Busch, that's a rand number. So we have one thing in there, we've got an implied rand depreciation where we think the rand will be in 3 years' time. That will play a role in where these numbers will end up. So consensus with, I guess, a weaker rand flavor to the numbers. And then we've got the dividend yield in the next column. And putting it all together, if you sum up pretty simply, what you get out of any company over a 3-year basis is the earnings growth and the dividend yield if there is no rating change. So what we think is all the rating entry points of British American Tobacco, which is the top one, Billiton the second one, Sasol the third one, Anheuser the fourth one, and Aspen the fifth one, all of those are acceptable PE entry points. What that effectively means is If we are right and we achieve the earnings growth plus the dividend, we will get those the next column, which is 15% from British American Tobacco, 12% from Billiton, etc. And then what we've done on the last column is just deducted inflation once again to give you a rough number. What we think is through time, actually, you'll get additional rating change in some of these companies that might enhance that number, but we don't know when it's going to come through. That's why it's always been Ford's philosophy is to not really time the market. We're in companies for the long term, and we let the company itself do the heavy lifting. If we try and job in or buy and sell a company, we can probably create more certainty and less volatility in the short term, but we will not be enhancing the long term, and will be not be investing the way we've always invested, which is to buy great companies, let them grow their earnings and pay out their dividends. And the rating actually is a very low contributor to total return if you're a long-term investor. And then, we'll take you through our view on why the Rand. I mean, we've spoken about the Rand and why we think we've got a weaker Rand, but maybe Will can just take you through the next chart, chart 8.
Yeah, so on chart 8, we show the current spot exchange rate and going back in time, and what we believe is a pretty good predictor of the future value of a currency. I mean, in the short term, there's many drivers of currencies, and sentiment plays a big role. Capital flows can really drive a currency's value either up or down in the short term. Improvements in economic activity, which means that your terms of trade change over the short term can be a further driver of currencies. But ultimately, what is very important for the longer term value of a currency is how competitive you are as an economy in producing and selling the goods you produce to markets that has use for your product. So relative growth in the GDP of an economy is critical. And unfortunately for SA, we have a labor market which almost puts a cap at this particular point in time on our growth rate because of the excess unit labor cost that we have to pay our workforce locally compared to many other economies globally. And one of the big differentiators here is that where your nominal pay and taking into account inflation may translate into pretty similar real increases for your workforce, in SA there's no compensating productivity gains coming through. So the widget that you produce today will be more expensive in time to produce because of a higher wage, but no productivity gain. Where,
in simple terms, the American guy will work an extra hour for his increase, and the South African will not work any additional hour for his increase, so he'll earn his increase by productivity gains.
Or fewer people will work in China, but they will have more machines and they can produce goods much cheaper.
So this is a different way of forecasting currencies. It's a known way, but there's the inflation differential basis of forecasting currencies, but this is unit labor cost, which takes into account an additional factor, which is productivity on top of it. So what's in the interest of time, I think, because we'd rather save some time for Q&A. If anything comes up on the currency, we can answer it on Q&A, if that's okay.
So, I mean, like I've mentioned, the currency is likely to be more volatile going forward because I think globally the economies are... we've very finely balanced. There's a lot of geopolitical and other risks on the horizon globally, so it can be quite negative for emerging market currencies, and that may further accentuate the move in the currency.
So what are we doing about it? I just, in thinking about the outlook, got a few things just to tell. I can see we're running out of time, so I'd rather do this as brief as possible. I think the first few years post the global financial crisis was easy. We're now entering year 10 of a bull market. Our view is the risk rewards are a lot harder to predict right now in equities. We do expect more volatility. There are many reasons for the additional volatility. It doesn't mean you shouldn't be in equities, but it does, at this point in the cycle, bring more volatility. I just broke it down into obviously in life there's positives and the negatives, and that balance is quite even. In America, we've got things like the Trump stimulus. You've got these huge tax cuts, infrastructure bills. The interesting thing, I'll just contrast it to one of the negatives. Listening to the AGM, or not the AGM, Warren Buffett's conference recently, I heard quite an interesting thing when he said, whenever you talk about economics, the important thing you say after someone tells you something about economics, you have to say to them, and then what? That is, if you want to understand economics, you have to use the words, and then what? So, Trump stimulus, and then what? What happens is the budget deficit blows out in the U.S. There are many things that come as a result. It doesn't mean that just because he's cut the taxes in the U.S. that they're off to the races and everything's great. There are many and then what ripple effects that come as a result of it. So don't see it as a unmitigated success, the tax cut for the U.S. economy. The other thing that's important is the U.S. consumer health is in a very good position. They paid back a lot of debt. They're actually looking pretty good. Arrears are actually not showing any huge uptick besides on the vehicle side of things. And after this big sell-off more recently, we have had a moving down of valuations globally to more acceptable levels. As I said, on the negative side, we've got one of the important things is rising real and absolute interest rates globally. And we've seen that is quite a headwind to world economies. Initially, people think that's quite an exciting thing as you see interest rates go up because it's a signal that things are getting stronger. But eventually, the actual interest rates start biting, and that can be a real problem. Another one that I've got there is the rising geopolitical risk, and we've seen the oil price more recently moving up significantly. And if you look through history, there are times that if you look on a year-on-year basis that the oil price doubles year-on-year. When that happens, that's one of the biggest lead indicators for a global recession. And it's because there's generally not a demand shock that's led to it, but more of a supply side issue that's led to it, that creates inflation, that creates rising interest rates faster than people expect. So there are things like that we're watching more closely, like the trade wars and the geopolitical side. As I mentioned, the seventh innings economically, and then when inflation comes, it is absolutely an underappreciated thing. It has ripple effects to the US 10-year, which filters through to the SA 10-year potentially. So we're cautious. But once again, thinking that equities is fine, but, not to be crazy and have a huge weighting either. You're 10, and actually, what you find now is there's incremental gains to be had from the equity market, but actually there's potentially a big Wile E. Coyote moment that can come in the next 3 years where you look down and there's nothing below you. So we're just cautious of that. And then on the SA side of things, we spoke quite a lot about the defensive positioning prior to ANC election. This is slide number 10. We were cautious on the noxious combination of rising public debt and that instability that could have been really bad. So we positioned cautiously, and everyone knows this is history, but we positioned low in domestic equities with a big offshore equity weight and high domestic bonds. That obviously didn't prove to be the best allocation once the facts were known, but we still believe it was the right thing to do given the alternate scenario, which people sometimes forget quite quickly about what could have happened, not what did happen. And then more moving forward, we absolutely acknowledge things are getting better. There are things that are getting better. So post-ANC, we are more positive on South Africa. We're not perennial Rand bear, South African bears. Things have got better. We acknowledge that. And, it's important that we have acknowledged that. But I think it's not done. There are many things that still need to be done. The structural issues are not over. We have things like Eskom having a debt to EBITDA of over 12 times, which is unsustainable. We've got things that I'm not going to elaborate on given the time constraint that we still are cautious on. And the problem is we would have more domestic equity, because we are more positive about South Africa. The only problem is the prices, and markets are discounting entities. So the prices of First Rand was 7 and 8 PE pre-ANC NEC. You've got First Rand that's now pushed up to a high of a 15 times at the euphoria. So we're cautious to not just follow the herd and go where it feels comfortable, which is to buy domestic equities right now, because of the other opportunities that we're seeing. But it doesn't mean that we're going to get there in a straight line. Dave's famous saying is, the markets go where
they need to go, but not
markets go where they are intending to go, but not when you want them to go, effectively. And then the last 2 points is we just really don't believe this whole comparison between Brazil and South Africa is the new Brazil, and I got many reasons why I don't believe we're the new Brazil, which I can answer in questions. And then just on the bonds, we've spoken about our position on the bonds. So we've kind of maintained our bond position, but we're not increasing our weight.
We take some questions if there are any.
Chris, can we open up the lines to questions, please?
Of course, sir. Ladies and gentlemen, at this time, if you do wish to ask a question, please press star and then 1 on your touchtone phone. If you decide to withdraw your questions, please press star and then 2 to remove yourself from the queue. Again, if you wish to ask a question, please press star and then 1 now.
So, gents, while we're waiting for some questions to come in, you mentioned the themes that you have in your global portfolios. Are they mirrored in the local equities, whether that's within the stable fund or broadly at Ford?
Good question. I mean,
Chinese.
The problem with South Africa, this is one of the bigger issues right now. When you invest globally, you've got the world as your oyster. There's themes that I could speak about, from artificial intelligence to anything. So, like, you could position yourself in any theme that you want, basically. The problem with South Africa is it's not that easy to segment. If we wanted to play the aging population, it's not that easy to do, if you get what I'm saying. So we don't just take those themes and supplant them onto our SA portfolio. What we do is we have specific thoughts and more general themes, I guess, on the SA portfolio. And one of the themes we played quite well was the rise in the consumer on the SA side of things. And as we felt that the headwinds were coming, so we actually downweighted that theme quite substantially across all our portfolios. So we do think about themes in South Africa, but we think about different themes to the global themes.
Gentlemen, we have no questions in the queue at the moment.
Okay. Just then another question from me. On the slide with some of the equities that you hold, there was a 17% earnings growth on Anheuser Busch. That seems quite high, given the stability of the cash flows.
Yeah. So what effectively happens is there's 3 components to that. I mean, there's a very high single-digit earnings before interest and depreciation. I'm trying to explain what an EBITDA, but earnings before interest and depreciation and amortization in a hard currency that we think that will come through. Then there are 4 times geared, so they have very good cash flows and they have a very good working capital cycle. So what you get is that number that I spoke about at a kind of ungeared level, and then the debt pay down reduces the debt substantially. So from a headline earnings perspective, you get a lot higher number, and then once you add in the rand depreciation onto that of say 4-5%, you get to that number. So if you minus 5%, you'll get a more hard currency number. I mean, that's why it was the premium company to own. This was the 3G model of BAS, and the other point is the SAB synergies are coming through to benefit the next few years. That's why I said it was a more simplified chart, because you're not, in my mind, I don't think you get that return out of Anheuser, because it's a 3-year return, and then they get to more normalized levels of 7 to 8% in year 3 because the gearing's paid down. Unless they do another acquisition and gear up and buy something like Coke or whatever, then which they've spoken about before, briefly. So I think in your minds, if you want to think about a year 4 to year 8 number, you're probably thinking more like a 6 to 8% ungeared earnings growth rather than those kind of numbers. Then you plus on the dividend, and then you realize there's very stable earnings. So sometimes security of earnings growth is quite an important thing. If you can think about how bankable an earnings growth is, then you start asking yourself, do I need as high a return? That's the stability of earnings. If there's a recession, I'll probably still do 7% earnings growth, but a cyclical company might do minus 20. So yeah, don't extrapolate 17% per annum forever in Anheuser.
Okay, thank you. Do you have any questions yet, Chris?
No, so no questions in the queue.
I challenge people. Come on.
Yeah.
Questions.
I'll answer one.
Okay. There you go.
Just a question to you. Just a little bit of comments on property, on the, both, I guess, local and offshore.
I'll let Will on.
Yeah, so I mean, locally there seems to be a disconnect between the current rentals within many of the listed property businesses, especially where they are focused on the office side and economic reality. So we're not an economy that's expanding, but there's a lot of increased space that has become available in certain nodes. And the issue we have is that if you look at the current cash flows from the rentals that you receive, as you come up for renewal and there's, in our opinion, a high probability of a negative reversion on a new lease, that is going to create a gap in your cash flows. But these companies are relatively highly geared. So your gearing doesn't change, but your underlying rental income does change and changes to be negative at a time where the NAVs are also not exactly reflecting a potential negative scenario for rentals. So it's more a case of looking at what we believe is the outcome for your rentals and taking into account that we don't believe it's going to meet inflation over the next 2 or 3 years.
But also we've got the domestic bond weighting, you know, so the way we think about things is not let me separate and have an allocation to bonds and have an allocation to property and have an allocation to equity. Whenever we're thinking about it, we're thinking about the risk reward of different asset classes. So we say, given the risk reward, we get more certainty out of a bond. We can get 8.5 or 8.4% right now. We can probably get slightly more yield enhancement by buying a property fund that's focused on office or retail, but we don't actually know the long term of how the oversupply in office is going to play out and how the oversupply in retail is going to play out in our minds. We'll probably be more interested in industrial space, as some of our funds we own Equitas, which is basically focused on the more logistics side of things. The only thing is that the yield there has moved up to a point that is not offering this exceptional opportunity anymore. But the thinking is not so much focus on office or retail, more industrial, and in some funds we own a weight in storage, which is the self-storage. So context is important and what property companies is important. And then obviously everyone knows that we have an allocation to capital and counties. We really do value the top tier retail nodes, especially a node that location is quite important with the walking traffic and the international and the showroom side of Covent Garden that's going to be quite protected against e-commerce. So when we start seeing something that can be taken on by e-commerce, then we start worrying. And the fact is that 90% of capital and counties price right now is underpinned by Covent Garden, and we get a free option on what happens with Earl's Court. So those are kind of focus areas.
I mean, the increase in the rentals in sterling terms for Covent Garden has been in excess of 10% in the last couple of years. So they've done a really good job in buying these properties at certain access points within Covent Garden, and then, you know, improving that and making sure that there's greater demand for some of the other properties that they own. So changing the mix from what it was previously towards one that's really focused on super luxury and food and beverage has been a huge driver in the uplift in rental growth. within Covent Garden.
Not to hop on it, but I think Earls Court, I mean, we think it's worth a lot more than it's being implied, but I mean, there have been some technical issues around Labour and Conservatives in the boroughs that Earls Court operates in, and therefore it is a bit more technical. I'm not going to sit here and say it's not as technical. There was going to be a lot more upside if they were able to add bulk to the land, but it's quite a political issue right now. But it doesn't negate the fact that Earls Court's worth a lot more. It just there was exceptional numbers that we could have made if we could have added bulk to Earls Court, which is probably off the table.
Okay. And Chris, do we have any questions before we go?
No, sir. No questions in the queue.
Okay. Well,
No one took up the challenge. It's okay.
Well, leaves me to say thank you very much to Nick and William for coming and giving us their time today. And thank you to everyone on the line. I really appreciate you dialing in and listening to what the chaps had to say today. Thanks very much. Goodbye.
Thanks. Cheers.
Yeah.